if there was a major problem with corporate governance. Now, this did not just apply to the banks. The central bank governor now, based on those rules, I cannot take up an appointment in any regulated entity for 5 years after leaving office. And none of my deputy governors can. And nobody in the central bank who's reached the level of director can take up an appointment in a regulated entity for 3 years after leaving office. So we did try to also look at the possibility of people, when they come to the end of their office, planning a very soft, well-paying private sector job, and that influencing all the decisions that they take as regulators. Now, I know I'm going to a country in 2 months where the central bank governor became the chairman of the board of the bank, and I do not pass any judgment on that, but you can infer from this what I think of that. And central bank governors never criticize other central bank governors, except by innuendo. We have a rule that says auditors who've audited a bank for 10 years have to be changed. Because again, we saw that auditors stay in a place for so long and they get so comfortable with the banks. And I've seen that those are also being considered right now in the European financial system. Now finally, we set up an asset management corporation, because that was the only way we could deal with the huge capital requirements of those banks that were in a grave situation. The asset management corporation we built in Nigeria was based on a model given by 3 institutions in Malaysia that were built after the Asian financial crisis: the Dana Carter, the Dana Modal, and a debt restructuring desk. So we have a company that has basically 3 functions. One is to purchase non-performing loans from the banking system at a price that is as close as possible to what is the estimated realizable value from the sale of the underlying assets. The second is to actually inject capital into those institutions, inject money in exchange for shares, and prepare those institutions for mergers and acquisition. And the third was to hold onto the loans and restructure them and try to maximize recovery. There are a number of unique features about the manner in which we did our asset management corporation. The first is that AMCON in Nigeria, the currency of AMCON is a bond guaranteed by the Federal Ministry of Finance and qualifying as an asset for the purpose of liquidity management and repos in the central bank. So treated like a government bond. So it's a 10, 15 year, we started with a 3-year zero coupon bond that will be replaced with 10, 15 year interest bearing bonds. But the unique thing about it is that the repayment, the redemption of this bond is in a sinking fund. And that sinking fund is one into which Nigerian banks voluntarily, after a very nice breakfast meeting with the CEOs, Nigerian banks have agreed to pay the cost of the cleanup. So we're not passing this cost on to the taxpayer. So AMCON would put in the proceeds of the sale of the non-performing loans into the sinking fund. And if there is any gap in any 1 year, starting from this year, every Nigerian bank has very kindly and graciously agreed to contribute 0.3% of its balance sheet into the sinking fund. And if there's any gap after that, the central bank governor shall politely request the banks to increase their contribution, and they'll very happily do it. So while Europe is debating whether the banks should bear the cost of the bailout or the taxpayers, our bankers have been very kind enough to agree to pay. And one of them is here, and I hope she will express on my behalf the gratitude of the central bank. We try to encourage a new, an orderly development of the financial system. So we've got commercial banks, we're now likely to have a few merchant banks. One or two international banks have already indicated that they've applied for merchant banking licenses. We have specialized banks. We've already licensed one Islamic bank, and we're looking forward to licensing PMIs. So the idea is to try and see how we can move away from a history, and this brings me to the end of the section on the restructuring of the industry. We come from a history in which the banks have been everything. So the Nigerian bank was a deposit-taking bank, basically with a balance sheet that's 70–80% savings and current accounts, very volatile deposits, but that was giving overdrafts, term loans, mortgages, doing private equity, underwriting. It was everything from a venture capital company to a project finance company. Okay, financing all of that with short-term liabilities. Now, what we've done is to take the banks out of that space. And working with the Securities and Exchange Commission and the capital market reforms, we do hope that the space now being opened up will be taken up by the institutions that should be in that space: private equity firms, venture capital funds, mutual funds, and the capital market will finally step up to the place, the pension funds, and provide the long-term financing required for long-term investments. So that the huge maturity transformation risks that were taken by the banks can be taken. Now, I suppose Basel III hopes to achieve that with the differential guidelines and the liquidity guidelines that it has. What we have done is simply stop the banks from doing it. Okay, so we're not talking about increasing capital requirements for different types of maturities. Basically say, you're a commercial bank, this is the business you should be in. If you want to be a private equity firm, or a venture capital company, set up a venture capital fund, set up a private equity company. I think one of the major problems that Basel III will have is that it falls into the same trap of thinking that by simply creating certain capital guidelines, you can alter behavior. Once a bank does its numbers and finds that it can make a lot of money and it's worth it to raise that capital, it will do it. But that does not mean that the risk will not bring down the institution over time. Now, we were faced with huge strategic questions in the middle of the crisis. Well, in 2009 December, we got the banks together, and this is one of the changes in process that we started in the Bankers Committee. I called all bank CEOs and we locked ourselves up for a weekend. The Committee of Governors in the Central Bank, it had never happened in the country. All bank CEOs locked ourselves up for a weekend in a hotel and said, okay guys, what happened here? Okay, now I know this is 2009, I know we all think our mothers have died, we're all miserable, but we will get over this crisis. But we're not going to get over it until we understand what went wrong. And one of the things that went wrong in Nigeria, which has gone wrong in Europe, which has gone wrong in the United States, is there was a complete disconnect between the balance sheets of banks and the real economy. The huge savings raised by Nigerian banks were deployed not to the finance of industry, not to the finance of agriculture, not to the finance of the real sector, but to speculation on asset prices. Now, I know we've heard this over and over again, and I read this a lot in the discussion outside of Africa, but I have not seen, for example, any serious attempt to address this in a conscious and strategic manner. Now, the result of that is, if you take the Nigerian economy, for example, 42% of our GDP is agriculture. But as of 2009, less than 1% of bank lending went to agriculture. The small and medium enterprises basically account for, 60–70% of formal employment. Only 3% of bank lending went to SMEs. And where was the money? Oil and gas, and well, some to the